Good morning from London. I'm Kriti Gupta alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. Reciprocal tariffs by April. President Donald Trump ordering his administration to consider fresh import taxes based on levies and non-tariff barriers from each country. And a 50% cut in defense spending. Donald Trump also floating the idea of a deal with Russia and China as a way to radically reduce military budgets. Meanwhile, the future of Ukraine as European leaders consider their role in negotiations. We're live at the Munich Security Conference. Guy.
Let's talk about these markets. There's not a lot of love on this board this morning, I have to say. Euro Stoxx 50 down by 0.4%. Had a really good day yesterday. European markets, a really solid performance. Euro dollar absolutely flat. Gold's the one you want to keep your eye on. Are we going towards 3,000? Kind of feels inevitable right now, doesn't it? European gas futures drop again. They were down by over 7% yesterday. They continue to drop. This as maybe the rules surrounding storage into next winter start to get loosened up. Does that potentially pose a big problem for next winter? Anyway, it's Friday. It's Valentine's Day. The countdown to the opening trade starts right now.
Reciprocal tariffs, there's two words. Reciprocal makes tariffs really fair.
There'd be no exemptions, right? It would be all auto imports?
Any exemptions now, because you don't need to.
By April is when you're going to get these reciprocal tariffs. The market's view on this, no chance. Way too complicated, completely unpractical. The chances of this actually becoming a reality, very, very low. Move on, look at something else. Be interesting to see how it works in the meantime. There's a lot of people going to be doing a lot of work, though there are fewer people now to do that work, so it's going to be interesting to see whether that slows things down as well. But the market consensus, Kriti, is there doesn't seem to be much chance of this actually becoming a reality. The market's already moved on.
Is that the interpretation, or is it complacency? Because he's not just saying reciprocal tariffs. He's also saying you basically have to quantify the non-tariff barriers, including VAT, including regulation.
How do you do that?
Exactly.
So that's why it's not practical.
Or you just can't model it, right? Like, I mean, who
Precisely.
knows? Exactly.
So you can't model it.
So at the end of the day,
you can't make it work. It is way too... You're basically tearing up the entire tariff rule book that the United States has at the moment. You're also ceding control of your tariff policy to everybody else. If they're reciprocal, if you're America and I'm Europe, I get to change my policies up and down in terms of the tariffs. You are going to respond to it. So America becomes a price taker, not a price maker when it comes to tariffs.
Or it could all just kind of open all the barriers and open the floodgates, 5 years down the road, and then things end up that way.
5 years down the road, 5 years down the road. I don't think we're going to be worrying about that this morning. The market yesterday very much focused on what the inflationary story is, and that, I think, is the complicating factor, is how these two stories come together. And that's the bit we're still left in the dark. How inflationary could all this be? How difficult is it to understand? Look, Safran's out with numbers this morning. Big European manufacturer. Basically, it's saying, we can't model tariffs. We don't know. Everybody's in the dark at this point.
Well, tariffs are one piece of the inflationary story. On the budget side of the United States, of the fiscal story, there's other ways to cut spending. And it kind of feels like that's where Donald Trump's head is at. Because on the one hand, you have tariffs, you have the reciprocal tariffs, you have the revenue story there as well. But then you have defense spending getting cut potentially by 50% in tandem with Russia and China. I mean, that headline, I think, was mind-boggling.
What I can't figure out is, does this just relate to the nuclear arsenal, or does this relate to conventional forces? And do we think that, A, American industry is going to tolerate this? Quite good at lobbying American defense industry to make sure that things continue along their current track. Do you think the Pentagon's going to be on board with this? Do you think the Chinese are actually going to significantly reduce in the midst of a massive defense ramp up? Do you think the Russians are really going to be reducing their defense spending right now? Also having ramped up massively. Again, the credibility around this, a 50% reduction in defense spending.
Ronald Reagan is somewhere in heaven, just rolling his eyes.
Yeah, Reagan went the opposite way.
Exactly.
Star Wars, basically, we're going to beat you by outspending you.
Yeah.
Was the lesson learned from Star Wars. The technology wasn't there, but he basically put it out there and caused huge problems.
There's a trade relationship baked here as well, because, of course, America is a major defense exporter as well. But Russia's number two there. When we saw the elements of that in his conversation with Prime Minister Narendra Modi in India, in terms of negotiating where that kind of end product might end up be, the likes of these negotiating F-35 jets, for example, to India, which buys more defense from Russia than it does the United States, I think is quite telling.
And the interoperability of that kit, Turkey had a big problem with that in the past. Also, can he say we're going to cut defence spending in half by telling the the Europeans to increase it to 5%. If we're going to increase it to 5%, shouldn't you be increasing it to 5%? Anyway,
yeah,
lots of inconsistencies, I would argue. Anyway, we're going to be live at the Munich Security Conference throughout this programme. There's some great voices coming up. General Carsten Brewer, the German Armed Forces Chief of Defence Staff, is going to be joining us. We're going to be speaking to the SAAB CEO. He is coming up a little bit later on. We're also going to be speaking to the President of Kongsberg Defence and Aerospace. Some great conversations coming up throughout the programme. Let's talk about some of the corporate stories. HSBC, the Jane Fraser playbook continues to be rolled out. The cost-cutting continues at HSBC. El Haredi driving that forward again.
Hermès numbers coming out as well this morning. And I think the headline here this morning is that they see added French taxes for 2025 at 350 million euros, but also they're looking at hiking product prices if U.S. tariffs are implied. This is a company that all of a sudden is planning for that reality.
The numbers are absolutely blowout. Sales at constant FX plus 17.6, estimate 11%. So the numbers are actually blowout. Veblen goods. If you make a Hermès handbag more expensive, do people want it more? Do tariffs actually work in favour of Hermès? Anyway, we'll put that one out there.
We should also mention NatWest is coming out as well. Those fourth quarter pre-tax order profits coming in slightly stronger than the estimates there. So that's certainly a stock that we're going to keep an eye on. And we should mention, as we speak at NatWest, our very own Anna Edwards is not in studio because she's nearby in London with a very special guest. Anna.
Chrissy, good morning. Guy, good morning. Yes, I am. I'm here with the CEO of NatWest. Paul Thwaite joins us. Really good to have you with us this morning. Thank you so much, Paul, for joining us. So the team was just going through a couple of the numbers, headlines, some of the numbers coming in better than expected. And there's a bit of an upgrade to guidance in here as well. Tell us what's driving the positivity.
Yeah, it's a very strong set of numbers, a strong performance by the business. We've delivered 6.2 billion of profit and a return on equity of 17.5%. We've also announced today that the government shareholding has come down to less than 7%. What's behind it is that we have a strategy that's working for our customers, but also our shareholders. Our three businesses, our retail bank, our wealth business and commercial bank, have all grown. They've added customer numbers, and we've grown both our lending and our deposits.
OK, and thinking about the ambition there, so a bit of an upgrade to some of the guidance, but you said about ROTE 15% 2027. I think you're above that already. So what's happening there?
Yeah, we've upgraded our medium-term guidance to greater than 15%. We don't put a natural limit on our ambition. I'm driving and pushing the business hard. 3 years out is a reasonably long time, but we're very pleased with the momentum we've got in the business, and that's why I felt confident to upgrade the guidance for 2027.
The gilts market and rates expectations in the UK looking pretty volatile. There's a lot of volatility globally in fixed income at this point. You're assuming quite a lot of cuts in 2025, I think, in your guidance. So there's upside potential, I suppose, if we don't get that. How responsive is your net interest income to that?
Yeah, I mean, we're a business that's heavily geared to net interest income in many respects. In our current economic forecast, we're predicting another 25 basis points interest rate reduction, so that would be 4 in the year. One of the features, though I'm sure you know, of UK banks is we have something called a structural hedge, which in terms limits the impact of the rate reductions. So I'm very confident about the income momentum we have for 25, but also into 26 and 27. And that's why I feel comfortable about the greater than 15% guidance for 27.
OK. And thinking about the UK economy, we got data out this week, the UK dodging a recession with 0.1% growth in the fourth quarter. For somebody at the coalface of this, how does the UK economy look to you?
Yeah, we're very realistic, I think, about both the challenges and the opportunities. I do think there are some grounds for optimism. Our customers have proven very resilient. We see good levels of customer activity in the customer base, whether that's mortgages, whether that's business lending. And yes, sentiment has dipped, but if you take a step back, some of the fundamentals are quite encouraging. You mentioned that interest rates are likely to come down this year. Inflation has obviously already come down. The labour market remains pretty strong. The housing market is strong. But it does vary. It depends what sector you're in. When I speak to businesses and customers, there's some sectors which are doing well. For example, professional services, some aspects of retail. There's other sectors who are finding it much more much tougher, whether
Yeah.
that's leisure and whether that's hospitality. So it's a mixed picture, I would say, and I think we'll learn a lot more as we go through the next 3 or 6 months. My role and the role of the bank is to make sure we're there for customers, whatever their circumstances.
And does any shakiness in the economy show up at all in your provisioning, in the cost of risk at this point?
Our asset quality is incredibly strong. We have prime asset books. Delinquencies in our mortgage business were actually less in 2024 than they were in 2023. A similar picture for businesses. And as I've said, I think customers have proven themselves incredibly resilient, not just through the interest rate cycle, but previously through the pandemic. So we feel very confident about asset quality, but it's something that we're never complacent about.
There's a lot of conversation about how the UK generates more growth, Paul. Is that something that you're advising government on, thinking about how the government should go about driving more growth for the economy?
The first thing I'd say is, it's absolutely right in my view that the government of this country is focused on growth. I've been very encouraged that they see financial services and banks as a key part of that. So I wouldn't say I'm advising the government, but obviously we're consulted, which we're very happy to give our views, and we've been sharing our opinions on what we think can make a difference to growth. Good countries need good banks. Good banks need good, strong economies. So that's how I think about it.
Let me take you to M&A and that subject, because we've seen some interesting reporting recently that's talked about whether you might be interested in Santander's UK business. Now, they've denied that that's for sale, but these reports keep coming up. Anything you can tell us about conversations that are happening there?
So I've been incredibly consistent in my 18 months in this role. I don't comment on any speculation on any business or any particular counterparty. I've also been very consistent to say I feel very confident that we can grow our business organically. I touched earlier on the momentum we've got in our retail business, in our commercial business, and in our wealth business. So I feel very comfortable we can grow the bank organically. But on an acquisition, when it comes to acquisitions, I have a very high bar. They need to be financially compelling for shareholders. They need to be very strategically aligned. We did 2 acquisitions last year, the Metro acquisition and the Sainsbury's acquisition. They fitted that criteria. So I'll be very disciplined, but I'll never comment on any speculation.
OK, so no comment on speculation, but you have said you'll be on the front foot when it comes to growing in the UK, I think, or M&A in the UK. And as you say, you've done some deals already. I mean, is M&A to grow the retail banking footprint in the UK something that you might be interested in?
Yeah, I'm very confident that, and I think we're proving that we can grow our retail bank organically. We're taking share in mortgages. We're taking share in credit cards. We've added over 450,000 customers in our retail. If opportunities come up, as we've demonstrated with Metro and Sainsbury's, then we'll consider them, but I'll be very disciplined.
And that takes me on to the government's stake in the business. And you said in the conversation earlier that you've announced today that the government's stake's gone below 7%. It goes back a long time that, of course, the money was put in and the government took a sizable stake in the business. What are conversations looking like right now with Treasury about when we see that being zero? So 7 down to 0.
Yeah. So first thing I'd say is I'm delighted that during 2020, since the start of 2024, the shareholding has reduced from 38% to less than 7% today. Ultimately, the sale of the final 7% and the timing of that is for the government and is for the Treasury. I've said previously, when you look at the current rate of sell down, it's likely that would be in the first half of this year, and that will obviously be a significant and important moment for the bank. But ultimately, it's the Treasury who will decide when they do that final sell down. Yes,
I mean, so lots of analysts talk about spring. Is that a vague period of time to have in mind when we think about when this might be a fully privatised bank?
It depends entirely on the Treasury. If you look at the rate of sell down in the first couple of months, it's not unreasonable to think it would be in the second quarter of this year.
And does that give you more freedom? Does it change anything for NatWest when that happens?
Not per se. It obviously will be a significant moment, in my view, for NatWest, but also for the country, because it will allow us to draw a line under what's been, as you alluded to, a long chapter. But it doesn't change anything from a strategy perspective. The strategy that I laid out last February is obviously working very well. We can see the momentum in the business. So in of itself, it doesn't change.
And just finally, Paul, I have to ask you about some reports we've seen in the UK media about the leader of the Reform Party, Nigel Farage, considering taking some legal action against NatWest. Is that something that has he been in touch about that? Is that something you're aware of?
And I'm sure you'll understand that it wouldn't be appropriate for me to comment on any individual customer or client. What I'm focused on is our 19 million customers and making sure we're delivering great services and products for them. So I'm sure you'll understand my answer there.
Paul, thank you very much. Thank you very much for talking to us. Paul Thwaite, the CEO of NatWest. Critty, back to you.
Anna Edwards there on location with the CEO of NatWest, as she said. She'll be back with us shortly, of course, as we digest some more of the corporate stories. Coming up on the program, Apple plans to overhaul China's iPhones with AI and joins Google in restoring TikTok after White House assurances. Plus, pharma stocks, chips, autos, they could all be in the crosshairs of Donald Trump's reciprocal tariffs. We're going to check on those sectors at the opening trade. Up next, though, we'll look at the broader market impact of the U.S. president's expanded trade levy talk. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
The first thing for investors to do is to understand what is the full potential adverse impact of tariffs if they're implemented.
We have higher prices and lower growth because everything's going to be more expensive. And also the tariffs are going to disrupt supply chains. So that's also going to lower productivity growth.
We've seen that when tariffs were announced on Canada and Mexico, they were preparing retaliatory tariffs. I think it's very unrealistic that other trading partners will just sit by as the U.S. puts tariffs on them.
What is his plan? I think it's very confusing for our trade partners not to know what it is that he wants.
The good news is the markets do sort of get a little desensitized to it. I think people realize that Donald Trump is a very unusual president.
I hear what David's saying, but selling maybe as well. And I'm not sure I'm desensitized just yet. Felt like it's been a long few weeks already of the Trump presidency. The question is, how much further forward are we in terms of our understanding of what actually Trump tariff policy is going to mean, particularly for the bond market? Well, let's try and answer that question now. And Witi Bakhuna, CIO of Global Asset Allocation at Northern Trust Asset Management, joining us around the table. Good morning.
Thank you.
Nice to see you on this side of the Atlantic.
Happy to be here.
Little break from what's happening in the States, but we're all around the world trying to understand what Trump's tariff policy means. The bond market is certainly trying to figure it out. What conclusions have you reached thus far, if any, about what not the short-term, but the more medium-term implications look like?
Sure. That's an excellent question. I think, if we look at where tariffs are in the U.S. currently, remember we already have tariffs on imports. The weighted average is somewhere around 3%. And looking into what's getting priced into the market as potential end state of these tariffs, market's pricing in around 6% to 8%. That's the range.
That's priced already?
That's priced already. That's what the markets are telling us in terms of what they think the end state of all these negotiations are likely to be. Near doubling, Guy, from where we are right now.
Okay.
But much less than the 10%, 25% headline numbers that he started out with.
And what's the degree of certainty around that?
So that's what the betting markets are telling us, that most likely scenario, 60% outcome is 6 to 8% tariffs at the end of the year when all this settles down. Now, the shocking part would be if it is actually 10%, that's not priced in. Yeah. That would be really bad for both bond markets and equities because the two are correlated. As you heard one of your guests say, it's bad for inflation. That means, bond yields rise. Yep. And then at the same time, equities sell off because it's stagflationary. Its growth goes down, inflation goes up.
You said it's priced 6 to 8%, but where? Where do you see that?
In the betting markets. There are odds being placed on
this. In the betting markets?
Yes.
But not in the financial markets?
Well, the financial markets are teeing off where they think it might end up. Because financial markets are playing off what the odds are. It's not unknown that there will be tariffs, right? That's been in the making for the last 2-3 years of his campaigning. He's campaigned on it. People are prepared for it.
So that's the equity story. The bond market story is interesting as well because there are these global correlations in the global bond markets. But is the way to trade the bond market now coming down to budgets more than it's coming down to tariffs and inflation? Is it coming down to the fiscal deficit story in the States, also matched with, say, spending and fiscal handcuffs in Europe? How are you thinking about that?
Yeah, bond yields rise up really for inflationary reasons. Tariffs a component of it. How do budgets play out is another component of it. So U.S. has had, it's another exceptionalism that bond markets don't seem to give that much worry on the fact that U.S. fiscal deficits have been 6 to 7% for the last 2-3 years. And yet yields have been fairly reasonable.
Yeah.
But we've seen those premiums go up. 20% of those premium increases have been because of inflationary fears. And then the remaining 80% is what we call the term premium going up in bond jargon, which no one knows what that is pricing in. It could be tariffs, it could be deficits, it could be growth fears, any of those items.
I think it's stagnating to me that you see completely different issues in the United States versus in Europe, and yet the markets still kind of trade very much in line with each other from a tick-by-tick basis. I'm not seeing that divergence.
The gilt market certainly is trading tick-by-tick in terms of what we're seeing in terms of the Treasury market feeding back in to the UK. OK, so we turn to Europe. Let's talk a little bit about Europe. The story this morning is Munich Security Conference. Europe needs to defend itself. It needs to spend more on defence. Donald Trump's talking about 5% as being a spending story that we should aspire to in terms of our aspiration. With the bond market, is the bond market OK with the idea that Europe is going to potentially take out more debt and spend it on defence? Is that something that will not cause a problem, or will it cause a problem? Or is there a view that it's a zero-sum game? i.e., if Europe wants to spend more on defence, it needs to spend less on welfare or less on something else?
I think that'll ultimately depend on all the countries participating in this, how they negotiated. They've always had a limit on how much you can borrow, which has been a limiting factor, Guy, for their growth also. Because growth has to come from somewhere outside of productivity. It's levering up some component of the economy.
So the only way to grow, for Europe to grow, is to lever up and spend more.
Yes.
And the bond market's going to be OK with that? Because at the moment, deficits are pretty high. Debt levels are pretty high. So we are OK with doing... Because the lesson out of the UK, the Truss administration, was that's not OK.
It wasn't OK. Yes. In the UK, it wasn't OK. That's the privilege that somehow US seems to get.
Yeah, but what about Europe?
Countries. So far, as Kriti said, very correlated. We'll find out. I don't really know.
Does the currency play a role in that? I mean, I'm looking at euro dollar at 104. We're seeing a little bit of a bout of strength in the last couple of days. How does the currency factor into that?
Currency plays an important factor because that leads to those inflationary factors playing in and then giving the countries room to grow more. Currency has been interesting, Kriti, because other than the bond markets that Guy mentioned, European stocks are doing very well also. They're doing much better than actually when we were looking at data last week. The two countries supposedly on the sticky end of tariffs, Europe and China, have had the best stock market performance in the last few weeks. They were supposed to be the most damaged by these tariff worries, and yet for micro reasons, they're doing better than anyone anticipated.
We'll have to see if that outperformance we're seeing in the last couple of days is a blip, a rotation, or actually sustainable. Unwithi Boguna, we'll leave it there. CIO of Global Asset Allocation of Northern Trust Asset Management, joining us around the program. Coming up, we're going to stick with that defense story. We're going to head over to the Munich Security Conference. The chair of the European Parliament Committee on Security and Defense Affairs will be joining the program next. Stick with us. This is Bloomberg.
29 minutes to the start of European trading, 29 minutes to the opening trade. Let's talk about what the futures picture is telling us right now. London underperformed yesterday. The rest of Europe actually had a fairly good day. We're holding those gains by the looks of things, judging by the numbers I see in front of me. Euro Stoxx 50 fairly flat, CAC futures fairly flat, which I think is interesting because Hermès has just come out with a cracking set of numbers, at least at first blush. There's a big kind of tailwind there. It does look as if it's still got pricing power. S&P futures are barely budging as well. We're up by 0.1%. Let's take a look at the bond market. Obviously, we had the inflation story we needed to factor in yesterday. This morning, not much price movement. Again, this feels like a market that is holding its breath, waiting to see what comes next. We're also going into a weekend. It's really been interesting. The market has unloaded risk into weekends recently. We're not seeing that just yet. Let's see how the session progresses. We also need to factor, obviously, in what is happening with the tariff story. I understand that's what's catching Kriti's eye this morning.
It absolutely is. I think it's catching everyone's eye because nobody quite knows what to do. And I think this is a really interesting case study because we are coming off of a meeting in Washington, D.C. between Donald Trump and Narendra Modi, the Prime Minister of India. I think this is really important because you hear in the rhetoric over and over again this idea of a trade deficit. That's where Donald Trump's focus is. If you have a big trade deficit with the United States, you're basically a target coming out of Washington when it comes to those tariffs. So this is what that relationship looks like with India. And even if you look back to Donald Trump's first administration, you can see that relationship has actually really deepened in favor of India in terms of the trade deficit story. Well, let's go into the nitty-gritty here because the United States is India's #1 trade partner, but India is the United States #10 partner. That comes to second base when you look at the European Union as a whole, where you start to see maybe Europe needs to be thinking about how India is actually factored in. Keep an eye on where the others are, China, Russia. So India is really playing among some of the major global economies in the world. And that's why this trade relationship really matters, specifically when it comes to where those negotiations could actually focus. I want to get into the areas of that because this could be some sort of roadmap or case study for other trade negotiations down the road. Defense is a big one, and this is important because defense is the #2 export out of the United States. Think Boeing airplanes, for example, but India is actually not the key buyer of American defense. They go to Russia for their defense. So off the back of this meeting, F-35 jets, for example, was one idea of really kind of making that trade deficit and that gap actually close. Agriculture is another one. That's the #1 export out of the United States. It's also where India has a lot of protectionism in terms of its rice export. So that's something that could show up. H-1B visas is a big one for the tech sector, guys, specifically because, of course, we know Donald Trump and the administration is kind of a hard line on immigration right now, focused on the southern border. But H-1B visas also apply to India and specifically the tech sector and hiring labor from that part of the world into the United States. And lastly, oil, of course, because we know India is a major oil importer as well. They're buying a lot of their oil from Russia at the moment. Is that an export relationship they need to focus on with the United States?
It is applicable to many different countries right now, Kriti, and you think about what is happening with Europe. Europe's trying to figure out how to respond. Trump keeps coming up with ideas, and the latest one is that basically Europe should just buy an awful lot of defense kit out of Europe, out of the United States. In some ways, that makes sense. Europe needs to scale up right now, and it needs to do it relatively quickly. Is the way to do that to deliver on maybe bigger defense spending? And that then poses a question about the long-term sustainability. Does that mean you are constantly and will continue to be in America's pocket? Or does Europe need to defend itself domestically? It feels like there's a kind of duration story here. Short term, maybe yes, actually, we do need to buy more. Longer term, we need to develop our own defense industry. How those things marry up, I think, is going to be a real challenge.
Well, this is something that's coming, almost 70, 80, 100 years after the last time Europe had to really increase their kind of defense spending in such a big, large-scale way. I think what's interesting here as well is that they have no money to do it. Whereas you're having these conversations with India, with China, with Russia, with the folks in the Middle East, even in Latin American countries, where they're sitting on actual extra money that they can actually put to use. You're seeing that in the corporate sphere as well. It doesn't feel like Europe has that fiscal room to really navigate, but it's not showing up in the trade just yet. And I think that's the disconnect you're seeing.
Europe does have the money. It's just got to decide what it wants to spend it on. Where does it spend its money is the key question going forward. Does it happen in terms of the green transition? Does it happen in terms of welfare spending, which obviously is very high in Europe? Do you need to put more into the defence story? You've also got an issue of what is happening within the labour markets. If you want to spend more on defence, now, the kit these days obviously requires less manpower, but the lesson coming out of Ukraine is you probably need more manpower than you think. Yeah. And that is the factor that Europe has also got to reckon with as well. How does it achieve that? So there's all kinds of aspects to this that will impact the labour market, will impact what is happening with budgets, what's happening with deficits. Yeah. Europe's just got to make some decisions on what it wants to do. The French want to gear up. The French want to lever up. They want to spend more money. Not everybody's convinced about that, but the money needs to come from somewhere.
The gearing up, though, is almost tied to the responsibility of debt at the end of the day. So Spain, for example, has been making this argument at the EU Commission of doubling the defense budget and doubling the investment on the condition that the entire group is then responsible for the funding and for the repayment of that debt. Obviously, we know the periphery, they're doing great right now in terms of their bond markets, but they're still dealing with massive debt issues as well and funding issues. So the two are kind of interesting in that you're almost having a replay of the conversation back in 2011.
Is Germany prepared to go down the mutual debt route? It has done once during the pandemic. People are still questioning whether or not that is a one and done or whether that is a model that can be replicated. It really depends on the threat. is there a realistic perception of the threat that Russia poses?
Yeah.
And maybe that's the critical part in all of this, an understanding of really how realistic that threat is and how dangerous it could be. Tariffs, obviously, the story front and centre as well this morning, alongside what was happening in Munich. Let's talk a little bit about how that is being priced in to these markets right now. Executive Editor for Asia Markets, Paul Dobson, joining us. Paul, there was a lot of noise yesterday about tariffs out of the Trump administration, about reciprocal tariffs. The market perception, to my mind, seems to be that actually this is largely unworkable. Has the market concluded that actually what we got yesterday isn't something that needs to be priced in?
Morning, Guy. Well, I guess it's something that was already more than priced in. Is there another way that you could look at it based on the way that the market reacted afterwards? You know, the fear that had been in the market that there would be, higher blanket kind of tariffs coming in from the Trump administration almost from day one. We didn't get it on day one. In fact, we didn't even get it yesterday, despite the rhetoric around it. We got a promise that it's coming in maybe 6 weeks, maybe longer, which opens that longer window for people to negotiate, along the lines of what we heard from Modi in the meeting with Donald Trump. It also gives you this idea that actually maybe, it's going to be a little bit more thought out or more thoughtful or more sensible or practical or kind of not something that's just done rashly but is considered, and therefore maybe the market can warm to that idea as well, rather than it being kind of that blanket approach that captures everybody all at once. And so what we've seen is a relief in the idea that it's not coming immediately, that there's room for negotiation, that it's not going to be all that punishing, at least not right away, and that there's wiggle room and that everybody else has time to prepare for it as well. We've got the dollar therefore weakening against the rest of the world's currencies. We've got equities in the US, they popped higher. In Asia, they've been having a good day. Not looking quite so rosy for Europe, which was already optimistic maybe about this. And we also, had a little bit of a drop in the bond yields extending after the Trump press conferences.
Yeah. Well, Paul, you talk a little bit about wiggle room. Let me take that to the next level here. When we do see these headlines come across, specifically when he says that we're going to evaluate on a country-by-country basis, it shows up in the FX space as the clearest trade. Bond markets, equity markets, they take a little bit of a moment, perhaps, to contemplate the consequences of that, as you just laid out. Does that create a dislocation between the bond markets and the FX markets that are traditionally so closely tied together?
Yeah, it's interesting because you've got that layered on top of the sort of relative yield play, which has been the key driver for FX markets for so long now. I think that, yes, the tariffs and that risk is definitely going to hang over markets still, like the sort of Damocles, and FX traders is that first line of response, as you say, Kritty. On the other hand, it all sort of comes back to the same idea. If we're going to have lower US yields, we're going to have a weaker dollar, and then the rest of the world is okay with it, because you also have that sort of inflation mechanism feeding through into the bond market. People worried about the idea that higher tariffs, yes, okay, they will punish the rest of the world, but they will also be inflationary for the US, and therefore they will push up Treasury yields and be supportive for the dollar. So it should all ratchet back together more or less, but you also have that premium that is coming in and out depending on the trade tariffs way of responding to it, particularly in those emerging market currencies which are responding so volatile to the moves.
Certainly something we're going to be keeping a very, very close eye on. 4 more years, Paul, 4 more years. Bloomberg Executive Editor for Asia Markets, Paul Dobson, joining the program this morning. You get more up-to-date analysis from him and the rest of the team. MLIV Go is the function on your terminal. Let's go from the macro to the micro. Get our stocks to watch with Joe Easton. Joe.
Morning, Kritty. So there's a couple of luxury stocks in focus today. Firstly, Moncler out of Italy last night gave a really strong report, and we saw the ADRs of those shares rising at around 10% on pretty low volume mode, but there does look like there was strength in the Asia-Pacific sales, particularly China. And then this morning, of course, another blowout report from Hermès, the Birkin bag maker. Sales continue to jump for that company, but bear in mind it's one of the best performing luxury stocks of the past year and pretty much avoided most of the downturn in luxury shares last year, given the resilience of those Birkin bags, where potentially expectations high. Does look like it's trading very slightly higher on the Tradegate exchange this morning. Then another company where expectations are high is NatWest. Now, the company's chief executive did explain to Anna earlier today that they are getting a boost from net interest income, and also potentially the company is going to go back into private ownership within the next year as the government continues to sell down that stake. But as we can see from the chart there, it's doubled in value over the past year, and analysts as well really positive. 16 buys on the stocks, as I say. Expectations high for NatWest today. Then in terms of aerospace, we've got Safran out of France, now a double component in terms of the business. They do the jet engines on the commercial short-haul planes, but also defence as well. Both of those businesses have been pretty strong over the past year for the company. But I'm actually seeing a couple of market makers calling the stock lower, given it's another company that's had a big rally over the past year. We can see it up around 40%. Bear in mind, defence yesterday was a really volatile day given the headlines around Ukraine. We actually ended higher on most of the defence shares given the optimism around spending. But defence, Safran, aerospace, all in focus once again in European trade this morning.
Joe Easton from our equities team walking us through some of the stocks to watch. We are about 18 minutes away from the opening trade across Europe, Guy.
We're going to talk about that defence story a little bit more in just a moment. We're going to head back to the Munich Security Conference. We're going to bring you a conversation with Kongsberg's Defence and Aerospace President. Front and centre right now in the debates. That conversation is coming up. The market open is 17 minutes away. This is Bloomberg.
We're about 14 minutes away from the opening trades across Europe. Futures are kind of muted everywhere except for the DAX. That's where you are seeing some real pressure in the futures picture, down about 0.4%. The rest fairly muted. We'll see how much of that is an earnings story. We'll see how much of that is a defense story, perhaps, or even just a retracement of some of the outperformance we've seen in the equity picture.
Many shocks for Europe this week. One of the primary ones came in the form of this conversation that we had between Donald Trump and Vladimir Putin. Huge shock, both for Europe's leaders. They're not part of the conversation, and really highlighting to the European defence industry potentially what could be coming. Oliver Crook is at the Munich Security Conference. He's talking to one of those people at the centre of this. Let's figure out what is going to happen next, Ollie. Talk us through it.
Yeah, so listen, Guy, as confusing as it is for you and me to kind of figure out what's going on with American foreign policy, what's going on with Ukraine, what's going on with potentially, Trump talking about wanting to have defense spending, China, Russia, United States. These are all big questions for us. These are much bigger questions from the people that are running the defense industry, and we're very pleased to be joined by one of them right now, Eric Lee, who is the head and CEO of Kongsberg Aerospace and Defense. Thank you so much for joining us. We're here at the MSC Munich Security Conference. A lot of activity over the last 24 hours. Put us the sort of importance of this meeting for you as someone who's trying to forecast what's going on in this industry and plan your business around it.
Yeah, I think this is a very important place to be right now. A lot of things are happening, and we are here to try to understand and also take, listening to the conversation that's going on, and also try to interpret how we can going forward as part of the industry.
And there are a lot of questions right now. There's even more questions over the last 24 hours. When you hear Donald Trump say that basically he wants to have an agreement with China, Russia, and the United States will basically half defense spending, their military budget. Again, it's hard to know what to take sort of literally, but you need to make your sort of investment decisions going forward on this information. What do you make of that?
Yeah, it's difficult to really get the understanding of everything. What I would say is that because of Ukraine, the world has changed, Europe has changed, and what we see is a long-term change in defense spending. We see an increase in Europe especially, and that's where we are, and look into that.
And so how confident are you in the sort of the order book and the sort of demand out of Europe? Because again, if you do get a ceasefire in Ukraine, potentially, again, this is all very speculative, but it's clear that the Trump administration wants to accelerate this effort. What will that mean for Kongsberg? What does that mean for your order book?
No, I think, we have a huge order backlog, and we also see this trend by increased defense spending. And so we will continue our ramp-up of capacity for production. And we do that both in Europe, in US and Australia to build up our capacity for ramp-up.
And part of the sort of conversation is also around tariffs and trade barriers. How do you anticipate that that's going to affect your business? Is it about sort of raw materials? How are your supply chains looking?
Well, nobody in the industry wants trade wars, obviously. But what we do is, we are a very international company. So we try to build in resilience in our supply chain by having redundancy in the supply chain. And so I think we look at that as a mitigating to do.
And given that order book, it's very good for you to have a big order book. It's not so good for your clients to have a big order book. How are you trying to sort of get that capacity level up? Are you able to sort of open up more sites? Are you going to be able to sell off that order book more quickly?
Yeah, we are able to open up new sites. So we are building up a site now in US, in addition to Australia, and we have already built up capacity here in Europe, and especially in Norway.
And I also understand you've been heading to Ukraine recently. You've been there over the last couple of weeks. Are you looking at doing projects there? I know a lot of defense companies are trying to get closer.
Yes, so I recently been there, and you know we talked to the authorities there, with ministers, and also with the industry in Ukraine, how we can help Ukraine building up their capacity. So with our air defense systems, we talk directly to partnerships with industry in Ukraine to build up the capacity.
And in terms of the efforts at the European level to try to get more joint procurement, try to work more collectively to get bigger orders, how is that looking? Are you seeing progress on that? Are there conversations happening there?
Yes, a lot of conversation, and I see some progress. I think it makes sense to have more collaboration, especially in Europe, more consolidation, and also maybe try to narrow down the number of systems.
And then in terms of the consolidation question, in terms of the defense industry, I mean, it's very seldom that something so big happens for an industry and there isn't much change. There hasn't been that much M&A. How do you see that progressing? Could you be an active participant in the M&A in the defense industry?
Yeah, you know, our business model is so that we have partnerships with many other companies. That's important.
Yeah.
And also M&A will be could be in our toolbox to do even more. So yes.
And when you think about that, what kinds of business do you think about expanding into? Is it more on the digital side? Obviously, you do a lot of hardware. Is it potentially something in AI and trying to appraise collecting data from the battlefield?
Yeah, you know, these emerging technologies, autonomous, artificial intelligence, and others are important for us. At the same time, if we consolidate on a number of systems, that could also be a factor in here. So everything is on the table.
And if you start to get big sort of procurement measures within the European, sort of saying much larger orders, could that put some pressure on your margins because of sort of the more sort of bartering power within the sort of larger orders?
Well, it depends, because when we are ramping up, we also have a scaling effect. So we try to keep the margin as we have today.
Okay. And then thinking about sort of how to get this industry in general bigger in Europe, right? I was looking at this sort of Euro Stock 600 defense index with twice as many companies as the American index. It's half the size in terms of market cap. How do you get this sort of growth into this industry? And your stock itself is up 700% over the last basically 5 years. Can you sustain that level of growth?
Yeah, I think so. We have stated that we will continue to grow. And I think this our company is based on a combination of civilian part, commercial side, and the defense side. And I think this needs to continue to build up the capacity and also the competence in the industry.
And about that partnership, because we've spoken a lot, I mean, I'm based in Germany, there's a lot of sort of talk about the sort of commercial industry going down and basically the defense industry coming up, and there are actually defense companies scooping up full teams from the private sector in the sort of commercial side. Are you looking at that? Are you having difficulty recruiting the number of people that you need for this ramp up?
No, we think the same way, so we don't see particularly big problems in recruiting people. And this combination of civilian technology, civilian companies with the military side is good for the defense business.
And I want to talk a little bit about some of the hardware, some of the things that you're developing. Obviously, you've learned a lot about the nature of warfare in the 21st century over the last 3 years, whether it's in Ukraine, whether it's in Gaza. What are the things that you see are sort of demanded in the market? And what are the things you're working to develop for your clients in new technologies?
Yeah, there are two factors here. One is the scale up for production. That's important. We are doing that. The other one is innovation. We need to adapt to new situations all the time. So that's the key area for Kongsberg, is to build up this innovation, especially around autonomous operation, artificial intelligence, and associated areas with that.
And J.D. Vance will be speaking in just a couple hours' time. What are you trying to listen to from that speech? What are you trying to extract from that speech and try to understand about the American position that's going to most influence how you're going to conduct your business?
Well, I think it's more for us to understand how they say it, and then we need to try to understand what direction that will be, seen from my point of view.
Right. Well, Erik Lie, thank you so much, the CEO of Kongsberg Aerospace and Defense, talking about all of the issues that are sort of front and center here at the Munich Security Conference, and all waiting sort of tense with anticipation for the words of the Vice President of the United States.
Looking forward to that. We'll bring it to you a little bit later on. Ollie, thank you very much indeed. Ollie Crook joining us from the Munich Security Conference. Do you need system consolidation? Do you need corporate consolidation? Are we looking for an Airbus, a defence in Europe? Are you looking for an MBDA? that is one of the few programs that has actually worked in the missile space. Do you need more of that? We're going to talk more about that a little bit later on. We've got some great coverage coming up from the Munich Security Conference. 2:30 p.m. UK time. Francine Lacroix is going to be moderating a discussion from the event. On her panel, Ukrainian President Vladimir Zelensky, got US Senator Lindsey Graham as well. There's plenty of others on that panel that you're going to want to listen to. We will bring that to you a little bit later on.
The timing of that is fantastic because so many Republican senators, Lindsey Graham, of course, standing out. At the same time that Donald Trump's talking about cutting spending, that's a Republican no-go in the United States. So we'll see how that immediate reaction is on that panel. In the meantime, you're seeing futures kind of sanguine, not super reactive at the moment, except for in Germany, where you are seeing some severe underperformance, down about 0.4%.
European markets had a really strong day yesterday. We're going into a weekend. Usually, over the last few weekends, it's definitely been risk off into the weekend. Wednesday looks like a good day. Friday's a little bit weaker. Maybe we're seeing some evidence of that kind of week in, week out seasonality. Anyway, coming up, the opening trade is almost upon us. We'll bring you the details of that next. This is Bloomberg. Friday the 14th, good morning. Couple of minutes to go until the opening trade. A lot of love in the market yesterday. Not so much this morning. Let's talk about yesterday, though, where we were getting a little ahead of ourselves. European markets surging into the close. Really solid session for European equities yesterday. And it continued after hours over in the United States. That's where we went out. That's the rally we got after the European close. That needs to be priced in this Friday morning, Critty.
Well, not seeing much action either direction this morning, Guy. We are seeing Eurostoxx 50 futures down about 0.2%. The FTSE 100 is basically flat, but I think where you are seeing a little bit of action is going to be in Germany here. DAX futures really taking a hit, down about 0.5%. This is important because we did see that rally in German stocks earlier this week. We'll see maybe if this is just a retracement or actually some fundamental story. I should say back from her travels, Anna Edwards, everybody.
Absolutely. Back from my travels all the way across the city. It is freezing out there, I can report. Let's get to some of the stocks that could be on the move this Friday morning. We've got NatWest certainly in focus. I was just speaking to the CEO. He was talking about being encouraged by the UK economic outlook, upgrading some of their guidance. So we'll watch how that one performs at the market open. Hermès certainly in focus. I heard you guys breaking the numbers here around an hour ago. Better than expected sales. Asia looking strong. Pricing power will be used, it seems, to counter any tariffs that might be coming for the luxury sector. So that seems to be of interest. And of course, we'll keep an eye on the defence names. We've heard from Safran this morning, their results and their guidance, boosting confidence perhaps. That's the view over at Citi. But the bigger picture around defence, we're live at the Munich Security Conference in a week where President Trump has said he wants perhaps the US, China and Russia to spend less on defence, but maybe more being spent by the Europeans, Guy.
Yeah, try and fit all that together. I think you're going to have a tough job. Let's talk about the market open Friday morning. What are we anticipating? I think probably fairly flat, but there's risk into the weekend. Do we need to price that as well? That's a factor to work our way through this opening trade. Right, here we go. FTSE 100. Absolutely flat. Yesterday, actually, the FTSE had a few laggards and it underperformed. Does that continue into the market this morning? At the moment, we are absolutely flat as a pancake. Not much to see here. The Stock 600, also not much to see here. The single stock story this morning, I think, is going to be where the interest lies. It is going to be names like Hermès. It is going to be some of those defence stocks. It is going to be NatWest, Safran, some of the other names that we're watching so carefully this morning. There's plenty to think about at a single stock level. I have to say, though, at an index level, it's looking pretty uninteresting. The IBEX is maybe the underperformer, down by a whopping 0.2%, Critty.
Well, I think right off the bat, you are seeing Hermès kind of take the cake here. It's your biggest index contributor to the upside. And I think it's really, from a sectoral perspective, paving the way for the other major movers to the upside. I'm looking at LVMH here this morning. I'm looking at Kering. I'm looking at Montclair, all seeing some green on the screen. I think that's where your leadership is when it comes to the upside and the Stock 600. But broadly, you are seeing more downside than upside, Anna. And I think that's where the pharmaceutical story really shows up, because your laggards here this morning, AstraZeneca, Novartis, Sanofi.
Right, yes. So that points to perhaps some concerns around that sector and where tariffs might fall next. We've heard that about reciprocal tariffs, not a great deal of detail, a lot of concern about whether, or a lot of questions about whether this will actually happen and when and how. But then on top of that, President Trump talking about specific sectors that could be in focus. I know autos was one of those. You were talking about pharmaceuticals as well. In terms of some of the individual movers then that we have this morning, of course, it's a little lighter on the corporate reporting front, aren't we, than we normally they are. I do see Hermès, though. If you look at things on a points level, Hermès doing really well.
Yeah, LVMH, second best gainer. Luxury sector is definitely getting a lift this morning. Moncler also had numbers out yesterday. That's going to give us a lift in terms of that story too. So we're certainly seeing that sector absolutely front and centre. HSBC Holdings, though, is the biggest points drop on the other side. Normally you hear restructuring, job losses, and the market takes that as a positive. This morning that's not happening, which I think is interesting. So why is that being taken maybe slightly differently? Anyway, HSBC is down by 1.1%.
I'm curious what the kind of read through is, and I mean you guys just went through the luxury picture as well, but I'll just add here, this is where the tariff story I think it gets really interesting, because this is a sector that is far more exposed to China perhaps in the Chinese story than maybe the United States story. Does the tariff piece bring it into full focus, especially as we're talking about maybe pivoting away from a Chinese consumer to an American one, if that's where the economic strength lies? Nevertheless, green on the screen across the board. You mentioned it, Moncler higher by 1.8%. Hermès is clearly your outperformer, higher by 4.8%.
But you have to have pricing power. That's the difference. LVMH, does it have pricing power? Do these other companies have... Hermès definitely has pricing power.
Yes. I mean, it's all relative, isn't it? They have pricing power versus a lot of other consumer-facing goods companies you could name. But yes, within the sector, Hermès certainly stands out as one that does. And they're talking about that this morning and saying that they'll use that pricing power to take on any tariffs if they are applied. Let's talk about the banking sector. Interesting, NatWest is down 1%. You were talking about HSBC being down. There's obviously limited read across between one and the other. One's very much more UK than the other. But NatWest is down this morning, despite I'm seeing on expectations that this stock might go a little higher this morning, but it's only down 0.8%. They're talking about when the government's going to get out of this business, that by the spring seems to be the thinking. We saw the sector under quite a lot of pressure from the Barclays numbers yesterday, so there does seem to be a little bit of a rethink there. I thought it was interesting, the NatWest CEO saying they're pricing in 3 more cuts from the Bank of England this year. And obviously that's not great for banks generally, even if they are cushioned by these sort of natural hedges. But that's not great for banks generally. So maybe there's some upside there if we don't get all of those rate cuts in the UK.
I just want to flag BAE Systems, big defence contractor out of Europe. One of the few in Europe that has a really big footprint over in the United States. And I just wonder whether or not you are seeing it react to the I'm going to cut defence spending story out of Trump, rather than the Europe needs to spend more story out of Trump. Because it's interesting that it's dropping this morning. I just want to take a look at the kind of slightly longer-term picture. But I wonder whether US defence stocks may have a slightly tougher day. BA had a really good day yesterday. Maybe we're just unwinding a little bit of that. Over the last 30 days, it's still up in positive territory.
Yeah, I mean, for the sector, what the result of that equation looks like, you know, US, Russia, China down, Europe up, if that equation could ever be put together, what the result of that would look like for the overall sector is a complex one.
Especially on a day where Rheinmetall is your biggest index, or I should say mover in the DAX, and a broadly lower index. The DAX as a whole down quite significantly as well. Let's talk about pharma here. I think we talked about all the other sectors. We talked about pharma a little bit at the market open, because we are seeing that really the laggard this morning. Novo Nordisk, to me, is I think the sole outperformer here, higher by about 0.3%. Now, this is important here because Novo Nordisk, I think 60% of its revenue comes from the United States. So that's really where you start to see, in the context of at least the tariff conversation, the trade conversation, or even the Greenland conversation with Denmark, Novo Nordisk serves as a key purpose. The rest of the kind of healthcare, pharmaceutical stocks on the back foot this morning.
What surprises me, I'm going to jump ahead a little bit, is that we're not seeing the same effect in the auto space. Volkswagen's actually positive this morning. I just want to double-check that it's actually open, but I think it has. You've got some losses coming through, so Stellantis is down, BMW's down, Mercedes is down, but they're not down a lot. And you would have thought that the firm focus of the Trump administration on this space maybe would cause a greater level of uncertainty. But maybe it's already priced.
Well, that's it. I mean, if you didn't know before yesterday what the tariff picture for autos is going to look like, you still don't know what the tariff picture for autos is going to look like. You know that there might be one tariff on top of another tariff, which I suppose is what you take away from yesterday listening to President Trump. Let's return to the defence sector, a real focus of our attention this week, of course. The European defence sector is on high alert as leaders and investors weigh the latest comments on Ukraine negotiations from the US administration. Let's now head to the Munich Security Conference, where Oliver Crook is standing by for us once more. Good morning, Ollie.
Yeah, and if diplomats are having a bit of a roller coaster day, so too is the defense industry. I mean, you just look at the sort of share prices across the industry over the last couple of weeks, and every time you get a comment, could there be peace in Ukraine? You see it go down, then you say you need to be boost more spending, spend more on U.S. SEC, and then again, this meeting yesterday you had apparently where Trump is wanting to have potentially, having the defense budgets of China, Russia, the United States. All of these things are coming into the mix right front and center here for a lot of these defense companies that need to make investment decisions on the things that they're hearing from the U.S. administration. And we're pleased to be joined by one of the people making those decisions, Michael Johansson, who is the CEO of SAAB. Thank you so much for joining us here. How difficult is it right now? Even a week ago, you said it's very difficult to have any visibility on what's going on for demand. How difficult is that for you right now?
No, absolutely. I said that a week ago, and I think it's even more true today. But we still see a high demand in the market. I mean, and I think the notion now, the view that Europe has to step up and do more, statements like that have been coming all the time now from the US side. So of course, if that is happening right now, I think many European countries will start to think about collaboration in a to a larger extent and actually spending more, and that will drive demand, so to say. So, but who can tell exactly what's going to happen if Europe comes together?
And on the European side, are you very encouraged that that is happening? I mean, there was a lot of rhetoric for a long time. You were a little bit skeptical when we spoke, I think, a couple of years ago. Yeah. Are you more confident now that Europeans are getting serious about this?
Well, I mean, from the European Commission, it is quite clear. When von der Leyen is putting sort of defense and security really high on the agenda, we have a new defense commissioner with a really high ambition on coming together, spending more money, identifying flagship projects like integrated air missile defense system, unmanned collaborative combat aircraft. It could be sensor technology. All of that must, of course, happen also, and it will be depending on politicians saying that, okay, let's put some eggs in that basket, the common basket, and get going on these things. But who knows? It's still a negotiation, and we have that at the same time as they are negotiating the next budget in the EU.
Yeah, and so more specifically, we're here at this event. We're going to hear from J.D. Vance in a couple of hours' time. From the people we're talking to, some officials are kind of concerned that this is going to be kind of a wrecking ball speech about basically Europe, you're on your own. What do you expect to hear from J.D. Vance? And specifically, as the CEO of SAAB, what are you listening for that is going to change your perspective on what you do?
No, you're absolutely right. Of course, you're listening to how much of an own responsibility do we have to take in the European context. That's sort of what you're listening to. You're listening to the support to NATO and how important the alliance is. That's incredibly important. And also the reciprocal type of trade between European defense companies and US. Will we have an option to actually build our capability in the US, and should we have the same reciprocal setup for US companies in Europe? Those things I'm listening to, of course.
Right. Of course, reciprocal these days is being used not to have more trade, but potentially less trade in terms of reciprocal tariffs. How is the tariff story affecting you, how you're thinking about your business?
Yeah, of course, we're monitoring that. Trade war is never good. But I would say also we are a little bit more of more lead time as a company because we have a little bit more in stock, and then we have sort of regionalized our supply chains to a large extent. So we're not depending on a certain hub somewhere in the world to say, get all our stuff into building platforms. But of course, I mean, over time, this is not good.
But meanwhile, you're also looking at expanding your footprint in terms of production capacity. Where could we see new sites from SAAB over the next couple of years? I know Ukraine is a site that you're looking at right now.
No, absolutely. I think we're moving from donation from countries, from us delivering into Ukraine to setting up support and maintenance of stuff, and then finding partnerships to actually establish both development and production capability in Ukraine. We have to do that, and we have to help them build sovereign capacity going forward. That's what we're doing.
And in terms of the impact of the Trump administration, specifically on domestic economic activity in the United States, there's a lot of euphoria within the market. Could you see yourself expanding as a consequence of the Trump presidency, your footprint in the United States?
No, absolutely. We took decisions like that independently of administration last year. We're building a new facility in Michigan, Grayling.
Does it make it more attractive now?
Maybe, I would say so. U.S. is a growing market to us, and we are investing heavily to boost capacity in the U.S. And it's good because we need redundancy, and the U.S. is a big market, of course, and also great support for export.
And then in terms of trying to build capacity out in Europe and other countries, what capitals are you talking to? What countries are trying to attract you to build your next sort of production
Well,
site?
you look at your main customer countries, of course. I mean, in Europe it would be UK, of course it would be Germany, it's Poland, but also a few others. Main customer countries where we build mini SAABs, not the full portfolio, but things where we have established sort of a good customer relationship.
And you have a huge portfolio of different products. When you're looking at your portfolio, you're looking at the demand for years to come. What's missing for you right now? What are you looking at in terms of possible M&A, where you need to build out your footprint?
But as everyone else, and we think we're still an agile company, we of course embrace new technologies to make more autonomous systems. That's absolutely going to be the future, independently of domain, in the air domain, subsea domain, and surface domain at sea. And I think things like that and taking care of the critical underwater infrastructure things are really in focus for me now, to bring expertise in, to take shortcuts into that sort of market.
So what does that look like? You're talking about patrolling sort of because obviously the undersea cable is something that's a huge concern for Sweden and so you're looking at sort of autonomous drones that operate underwater?
We have autonomous and remotely operated vehicles today. We can put them being resident underwater and sort of turn them to life when they're needed to monitor something. And we can put sensor technology on them to actually see what's happening at the surface level, but also subsea. So that can be done. The question is, who is the customer? Because, I mean, these cables are owned by certain companies or countries, and it's not obviously the defense who is the customer to us. So that needs to be sorted as well.
Right, and then also another sort of factor of having all of these products and all of this, you also have huge volumes of data, and you have you have sort of eyes all over the battlefield. Is there a sort of, who are your partners for trying to look at analyzing that data? I'm thinking about AI. I spoke to the top general for the Germans yesterday, saying that basically if, the West falls behind on AI, it could be a massive risk for the military industry and for their own defense. How do you see that, and how do you attach that? How do you attack that? How do you get the sort of AI integrated into it?
No, you're right. I mean, it's a bit sort of like islands today. Of course, we have our data centers, you would say, based on the platforms that we have with lots of sensors and things on them. But you need to take it down another step. I mean, as countries, NATO, creating a cloud-based sort of protected environment, secure environment to share data, and that are decisions that are still need to be made in different countries around it, including Sweden. But we're getting there, I think. It will need partnerships.
When you walk away from this conference at the end, by the end of this weekend, what do you hope to know more about and make your to inform your decisions that you're going to be making going forward?
I hope to see that it's for real, that Europe decides to step up, at least the majority of the countries, so we actually get things going on spending for common flagship projects. That would be great to hear, that we're not sort of hesitating now and having this consensus sort of way of looking at things, spreading our money over all 27 countries. We should sort of realize that we have some countries with really good defense industries that can help quickly boost capacity and capability in Europe. I mean, because we need that independently of administration in the US. We will have the Russian aggressor to our east and not being predictable for a long time. So we have to realize that. Some countries do, some countries don't.
Well, Michael Johansson, thank you so much for your time today. That is the CEO of SAAB here at the Munich Security Conference, dealing with the great uncertainty that is coming, yes, from the Trump administration. Could some of that certainty, though, be coming from the Europeans? That's what he hopes to learn today here at the Munich Security Conference.
Oliver Crook there with the CEO of SAAB, of course, at the Munich Security Conference. We thank you so much. Coming up on the program, we're going to stick with the corporate theme, optimism from the French telecoms giant Orange as it returns to profit in its home market. We'll be joined in the studio by the CEO next. Stick with us. This is Bloomberg.
Welcome back. This is the opening trade. It's Friday. It's Valentine's Day. There's red on the screen. I'm not sure if that's appropriate or not. Stocks are a little in retreat this morning, down 0.2%. The CAC 40 is actually flat, though, and that's being lifted by the luxury sector. So Hermès and the strong results at the luxury sector boosting that market. But, Chrissy, we need to go to a different sector within the French market.
Different colour as well.
No love for stocks.
Let's not argue about whether this is orange or red, because this has been going on for a long time.
That's why you have to wear purple.
This morning it's orange. orange.
Well, let's stick with another stock here, another corporate stock. Telecoms operator Orange has forecast improved earnings growth this year after profits rebounded in France, its biggest market. The company has resisted cutting prices in its home market, positioning itself as a premium service. The CEO, I'm pleased to say, of Orange, Christel Heidemann, joins us in the studio for an exclusive interview. It's lovely to see you here in London. Thank you for coming by. Good morning. Look, these numbers were really strong yesterday, and even the analyst community had said, wow, this is kind of coming out of nowhere. What do you attribute that strength to?
Well, we've been focusing for the past 2 years on our Lead the Future plan, on execution and on, fixing some of the issues we had, but also leveraging the great assets that we have. We have fiber everywhere across Europe. We have a fantastic presence in Africa, fast-growing market. So we really operate in the European environment on next-generation network, benefiting from our fiber coverage. We are the leader in Europe. And, of course, Europeans are adopting broadband. We have cybersecurity business growing as well. So we've been benefiting from all, I would say, our top priorities, and that's the execution of our strategic plan.
Well, talk to us a little bit then about how that shows up in the context of perhaps some of your other peers based in France, cutting a little bit of costs, worried about the political environment, worried about the geopolitical environment. You seem to be going against the grain in that backdrop.
Well, the solid results in France are first and foremost the result of excellent commercial performance. And our teams, our customers, we have the best NPS, we have the best network quality, we have the lowest churn on the market, and that's the key in very mature market like telecoms these days in Europe. Of course, we have the average revenue per user increasing. We're benefiting from customers migrating from copper to fiber. And there's a premium when customers buy fiber. So that's been driving growth. And that's the first and foremost priority for us. Of course, we continue to drive efficiency. Actually, we've been talking a lot about AI as well. This week, AI was everywhere.
Yes.
But in the company, we really use AI first and foremost to empower and augment our employees. And we've said it yesterday, in 2024, AI was for us 200 million euro of value across the company. And it's a mix of more revenues when we do customer value management and we optimize our footprint. And it's also, of course, cost efficiency.
Okay.
So all of that is in the results that we've announced probably yesterday in 24 hours.
And that all sounds like it costs a lot of money to investing in AI, investing in a lot of infrastructure, then, Christel. And I wonder what pricing power businesses like yours have for various types of customers, because sometimes I feel maybe we take for granted the phone in our pocket that will work when we need it to, or business customers perhaps need their, do so as well. So what constitutes, how do you have premium pricing power in this industry?
Well, for a long time at Orange, we've been focusing on what we call convergent customers. And obviously, we have all type of offers. Our cheapest offers, and this is somehow crazy in Europe if you realize that the price of a mobile monthly package is the price of a burger these days. When you realize how essential it is for us to have connectivity, nobody can work, live, without mobile connectivity. So this is very cheap. We invest billions, actually more than 6 billion every year in our networks. I think we take it for granted. We've been doing, fiber rollout across Europe. This is like tens of billions of euros that we've been investing. So this is it. Now, it's true that we offer all type of packages. We have customers who really want the premium packages because they consume a lot of data, they travel, they want, reliable fiber. But we also have, students who need a low-cost package. So we want to offer everything. We've been doing inflation time, some, price increase, but this is not mechanical anymore. So we really play on volume and value. We've been offering for customers some cybersecurity offers. This is working as well. So there's not one size-fits-all solution.
My experience of students is they tend to use their phones more than maybe we do.
Anybody else?
Is there too much competition, though, in Europe that actually we're not investing enough? This is an industry, like so many industries in Europe at the moment, there's this complaint about regulation. There's this complaint about the fact that we need scale. You talk about it in the banking sector. We've just been having a conversation about the Munich Security Conference about the fact we need consolidation within the defence space. Do we need consolidation within the mobile space, within the telco space, in order to provide the investment that Europe digitally needs right now?
We do need consolidation. Actually, Orange, we've been doing it actively.
Sure.
We've been driving consolidation
How much
nationally.
more do we need? How much does it need to accelerate?
You look at the European Union has said it. There's a telecom report that says we're missing 200 billion euro of investment by 2030 if we want to bring 5G and fiber to all Europeans.
And consolidation will solve that problem?
And consolidation will solve that because we are a fixed cost business. So if you're the number one in a country, you have more ability to invest than if you're the number 3 or the number 4. And in some countries, we have 5 operators. Think about it. In the US, there's only 3 mobile operators. In China, 3 mobile operators. In Europe, we have 27 countries, and we have at least 4 operators in every country.
And regardless of how many operators there are, there's a lot of infrastructure to invest in. And I know the industry, under what we called fair share rules, has been trying to argue that tech companies need to pay more because they benefit when you provide broadband to somebody's home, for example, or someone's phone. So that didn't get anywhere. But I wonder, with the AI theme growing and growing and growing, do you push for that again in the sector?
Well, it's not about, what we want as an industry is to make sure that when we invest for the network, it's us deciding to invest for our customers. The challenge that we have today is that some of the platforms and the big platforms are driving so much traffic on our networks that we are forced to investing just for them to continue to grow because their business model is based on more traffic. So that's the issue. Now with AI, we believe there's going to be a new paradigm because AI today, everyone is talking about the hyperscalers and the huge data centers. The reality is that AI, if we think about AI at scale, AI will happen on your mobile phone, in the cars, in hospitals. So it's going to happen at the edge. And the inference of AI will put some pressure on our networks. The traffic generated by AI will be very different from the video traffic. So we're convinced there's going to be
Are you already seeing it? Is there already a pickup?
No, for the time being, we don't see the impact of AI on our networks, but we want to be ready. And we want to make sure that we're building the right business model so that this time we don't miss the opportunity to capture value from AI adoption for our customers.
Nice to see you. Thanks for stopping by to come and see us. Christelle Hayden, CEO of Orange. Coming up, Hermès sales are jumping. The company has pricing power. Europe is certainly seeing a luxury. It's Valentine's Day. Maybe luxury should be up today. I don't know. Apparently jewellery sales go up on a day like today. More on that next. This is Bloomberg.
This is the opening trade. We're about 30 minutes into today's session. Seeing some, I want to say, marginal moves. A little bit of volatility in the German index, I think, is the where to look. Down about 0.3%. It could just be a little bit of risk off ahead of the weekend, as Guy mentioned earlier. It could also simply be a rotation of what we've seen throughout the rest of the week. A string of good days for Europe, even better days for the DAX. Maybe, Guy, just a little bit of a reversal today.
Yeah, and Europe's had a really good run, as you say. Maybe a little bit of that's coming out of the market. Let me just quickly check and see what Hermès is doing this morning, because at the get-go, it was up quite strongly. We've faded that move a little bit. We're up by around 3% right now. Sales jumping almost 18% in the fourth quarter. That certainly beats most analysts' estimates. Joining us now for more on what this means for the luxury sector, and we've also had Moncler out with numbers as well, as Andrea Felsted from Bloomberg Opinion. Morning. Why does Hermès have pricing power?
Hermès is very different from anybody else in that it can basically dictate its own level of demand because it has capacity constraints. There are waiting lists for its most in-demand products, mainly the Birkin bag and the Kelly. So in tough times, it just works through that list.
Has it raised prices as aggressively as others? Does it have it more in the time? Because everything else kind of felt like it went up really, really quickly. Obviously, I follow this stuff very carefully. It went up very, very quickly. Did Hermès deliver that same punch in terms of the price?
No, Hermès' products are very expensive. You're looking around $10,000 for a Birkin, roughly.
Yeah.
It didn't actually push up prices as aggressively as others. Also, it's worth remembering that if you want a Birkin right now, you can't just go in a store and buy one.
Yep.
You have to register for interest, see whether the store gets
like
the model you want. Yeah, basically. Probably a bit rarer than a Rolex. But if you wanted to say, I've got to have a Birkin right now, you can go to a resale site. You will pay double in the store. So the fact that it didn't push up prices quite as aggressively as others, plus that the differential with resale means that it's probably one of the few that's still got some pricing power.
Well, talk to us about what that hit looks like in terms of the tariff story. Because guys right in that it has the extra pricing power. You're seeing the CEOs talk about the fact that they could increase their prices in response to tariffs. But can you just quantify what that tariff impact might look like on Hermès' business?
Well, I mean, we don't know what tariffs are going to be. I think Hermès is one of the few that could put prices up. Customers would wear it, literally. For many of the others, I think it's going to be very tough. If this was 5 years ago, I would be here saying luxury goods haven't got anything to worry about with tariffs. Their customers are wealthy. They can put up prices. It's going to be no issue. They have raised prices so aggressively over the past 5 years that ability to raise prices more is really not there. It's going to be a real struggle unless we have another boom to raise prices as they did before.
I mean, it's all very unpredictable, isn't it? I wonder if there are wealthy women in America getting in Trump's ear and saying, just not handbags. Just not handbags.
Don't touch those.
Let's talk about the China story, shall we, in the context of Hermès, because it's complex to work out what's going on in China. So the CEO, Axel Dumas, saying it's too soon to talk about a China demand recovery. But are there green shoots?
Well, Moncler actually was more upbeat about China. The feeling from the results that have come through recently is China's not getting any worse. It's not clear whether it's getting better or not. We've just had Chinese New Year, so we've got to I think, get through that to see what the underlying picture of demand is.
What do these companies do with gold prices? Do they buy forward? Do they hedge? Gold just keeps going up and up and up. Precious metals keep going up and up and up.
That is definitely an issue for them. It's something that hurt Swatch a few years ago. It has inventories that are sort of very valuable. But I guess they just have to deal with it. And if it does go up, they'll have to reflect that in the prices.
So do they have big inventories of gold, silver, whatever it is?
Well, Swatch has very big inventories, some of which are precious metals. And that's been a real thing for investors because the value of the inventories is about the same value as the company.
So I can revalue these luxury... Every time gold ticks higher, basically, in theory, luxury stocks should be moving higher as well, because of the inventory.
I'm not sure about that because I think generally raw material is quite a small part of the overall
if you've got a big load of it in the bank or in the vault, then presumably it's worth more on a daily... I'm just curious.
Presumably it is, but I think translating that into sales and into products...
They've also got to tell us how much they've got.
Yeah, which many don't. Swatch, I'm not really up on this, but I know Swatch is one of the few that puts out its inventories.
They're going to have to call you up and get you to consult on some of their gold
very
strategy.
All I know is that every day gold seems to be going higher and higher and higher, and these companies use a lot of it.
Do they market to market? Do they mark to market, I wonder?
Yeah, exactly. A bit like the US Treasury, or not.
Bloomberg Opinions, Andrea Felstead, walking us through all of Guy's questions.
Yeah, sorry. Probably took you down a rabbit hole you didn't really expect. What else do you need to know this morning? Let's turn to Safer Ground. What is happening with the technology sector? Shares in ARM Holdings have jumped on a Financial Times report that it's landed Meta as an early customer for its first in-house chip. ARM will reportedly unveil the first chip to be sold under its own brand as soon as mid-year. Let's call it mid-year. ARM is best known, of course, as a chip designer, licensing its technology to others instead of making its own products. Bloomberg has learned that China has invited prominent entrepreneurs, including the founder of DeepSeek and Alibaba's Jack Ma, to meet the nation's top leaders, a potentially momentous show of support for the private sector after years of turmoil. Sources tell us that President Xi Jinping is expected to attend and meet, and the meeting may happen as soon as next week. Bloomberg has also learned that Apple is working to bring its AI features to iPhones in China by the middle of this year, with a launch potentially maybe mid-May we're talking about. The company is relying on local partners like Alibaba and Baidu to adapt its Apple Intelligence platform for the region. The rollout is, of course, a high-pressure task for Apple, which has suffered a steep sales decline in China, its biggest single market outside of the United States. We should also talk about TikTok. There's Reddit. Reddit is a really interesting story as well, which I think is, I quite like to talk about that too.
The fact that Apple is partnering with Chinese large cap companies when 4 years ago they were targeted from the Chinese administration under trying to get the Huawei smartphone kind of to be the major player there, which it still is, but Apple was trying to eat into that. But then also really having to talk to Donald Trump and kind of getting in his ear in his first administration and saying, don't do this tariff stuff. Don't kind of change our supply chains. They even had to react and move a lot of it to India outside of China. This feels like a 180 for Apple. And now on top of that, with the TikTok story, TikTok is coming back on Apple stores. It's not legal yet, but it is.
Yeah, Pam Bondi apparently has said it's okay, so
yeah,
they're going to do it. And also, the longer it's off, the more problematic it is to sell, I'm assuming.
Yes, and we don't know yet, do we? Still don't know who's going to buy that. And Elon Musk perhaps distancing himself a little bit from that. Shall we talk about that Reddit story? I think that is fascinating. So we remember during the meme stock craze that Reddit was everywhere, and plenty of people were on Reddit talking about financial markets. They still are, of course. And we followed all the ups and downs from crypto and beyond. And now we've got a tool, an exchange, the International Exchange is going to be partnering with Reddit to try and bring that as a sentiment indicator as to where consumers are at to the markets.
Well, retail investors, they're basically going to tag it all and allow you to plug it into your algorithm. This is so ironic, in as much as the Reddit crew were the antithesis of the kind of traditional, particularly the shorts-only side of the investment industry. Yeah. And now the investment industry's gone.
Yeah,
no.
they had big hedge funds in their sites, and now the big hedge funds have Reddit in their sites, saying, well, you're useful.
But you won't be able to use it the ability of the professional financial industry now to react and monitor is much greater, i.e. they're solving that blind spot that they had that cost so many funds so much money.
React and monitor, but then on the other side, there's an opportunity almost to manipulate the market as well. So I wonder how quickly there is a regulation standpoint that has to come to this now that you can basically swing the sentiment indicator.
Well, yeah, can you swing a sentiment indicator using only emojis? That's what I'd like to know, because it was all about diamond hands and rockets and moons and all of that, something to do with chicken that escapes that I can't remember. But anyway,
so some sort of translation feature probably required.
Absolutely. And then I started
clearly of the times.
then I started wondering whether you need this in a day. AI would love to do this for you as well, wouldn't it? Various AI tools would love to do that. But then they'd have to have the access and the large data sets. But that's an interesting
But we already have kind of models that effectively screen speeches, that screen pretty much everything, tag it, give you a sentiment, give you a readout. Was that hawkish? Was that dovish? Effectively, this is just applying some of the same technology to what is happening on Reddit. But again, it speaks to the power of these data sources and where value lies. Is a company like Reddit more valuable now because it's able to harness this? But then how do its users feel about the fact that Reddit is doing this? And will this ultimately, therefore, prove to be a negative?
But I also want to know how I don't know if you spend as much time as I do interpreting messages, for example, but if I get hypothetically...
That's very little.
Probably. But, if I get a text message from someone, I don't fully know what it means or what the sentiment is or whether it's just, a quick response or something more.
You are definitely overthinking.
No, but this is how people think on social media. You should get on it sometime. Figure it out.
You'll be welcome, apparently, guys.
The read-through is my point, is that it's open to interpretation, so it's not a science.
But don't understand it, just ignore it. That seems to be the strategy.
Adulthood.
Yeah. It's very simple, very straightforward. OK, talking of a lack of understanding, the Trump administration telling its European allies to buy American weapons in order to maintain the NATO alliance. We're going to discuss this next with Keir Giles from Chatham House. That's next. This is Bloomberg.
Welcome back to the opening trade. We're 45 minutes into today's session. These feel like muted moves to me. I am starting to see some underperformance. It went from Germany to the UK. The UK is now your underperformer of the region. The FTSE 100 down about 0.4%. If you're looking for a moment of optimism, though, perhaps it's in the French numbers. A lot of that driven by the luxury story. Good numbers coming out of Moncler and Hermès as well. That index higher by 0.1%. A good chunk of that, though, exposed perhaps to the United States and the tariff story. Let's go there next. The U.S. President Donald Trump has ordered his administration to consider imposing reciprocal tariffs on numerous trading partners. The development raising the prospect of a wider campaign against a global system that he complains is tilted against the United States. Bloomberg's Brendan Murray, I'm sure, has his head spinning. He heads up our trades coverage and is joining us now. Brendan, this is tricky in so many ways. The math around it is hard, but I think what stood out to me was that it's not just what countries have tariffs on the states. It's also using what he calls non-tariff barriers, things like regulation, VAT, et cetera. How do you quantify that?
Yeah, I mean, if Trump's favorite word is tariff, it seems like his second and third favorite words are taxes and regulation. So he announced yesterday a process by which his administration will investigate and review the trading relationships with all sorts of different countries. They're going to start with the ones that have the biggest trade deficit, trade surpluses with the U.S. And he's going to sit down at the table and say, okay, let's talk about tariffs, but also let's talk about these other things, these other measures that you have in place that we think disadvantage our exporters. So that just opens up a whole Pandora's box of issues, from value-added taxes to environmental regulations to food standards. It's all kind of on the table now.
Anna wants to talk about VAT. I'm going to leave that to her in just a moment. Brendan, this sounds epically convoluted and difficult. And is it going anywhere as a result of that? And the market's the consensus seems to be yesterday, he's bitten off more than he can chew. We're not going to see this happen. Is that the right reaction?
Yeah, I think that as we've seen in just less than 4 weeks of this administration, there's a big announcement. It makes a big splash. Everybody starts to wonder what this all means, and then the process behind it takes over, and something more measured is where we end up. I think that's probably the case here. If I were the European Union this morning, they're probably waking up and going, what are we going to do now? Because they had their list of things that they could retaliate against U.S. products. But now, if all these other things are on the table, then that just changes the ball game, really. So part of Donald Trump's strategy is to kind of confuse and sow disruption, but that's by design. And so we'll see how it plays out. But if you have a big trade surplus with the U.S. today, you're going to be looking very closely at how they wind up, how this review winds up in 6 to 8 weeks.
Yeah, that's interesting. Even if you're a place that doesn't have a very big differential in terms of percentage tariffs, one versus the other, US versus your own trade. Let me ask you about VAT. As Guy said, I did go down a rabbit hole on this. So what is President Trump's what is his problem with VAT? Is it that companies that export from Europe get what you might call a VAT exemption because they're not actually selling it to a customer, it's going to a different country? Or is it something to do with the fact that European manufacturers can recover some of their input VAT costs? I mean, Brendan, have you got answers on this?
I wish I did, but I think both of those things will be part of the discussion. The Europeans will most certainly argue that a VAT is tariff neutral. It doesn't disadvantage the U.S. But this has long been an issue that Trump's advisors now, Peter Navarro, he has a commerce secretary who's coming in who's also shared these issues. That they are definitely going to sit down and debate. It's an open question as to whether this disadvantages the American companies, and so we'll see how it ends up. But they're definitely convinced themselves that they have leverage in this department.
To be fair, I'm not sure I'm a big fan of VAT either, but we'll park that one for the moment. Brendan, great stuff. Thank you very much indeed. Bloomberg's Brendan Murray.
Let's stick with themes coming out of the White House right now. The Trump administration is said to have told European allies they should buy American weapons and military equipment in order to maintain the NATO alliance. This clearly would also help the trade balance, referencing our previous conversation. Perhaps part of President Trump's transactional approach to US allies. Joining us now to discuss what we have learned about the Trump administration and its approach to defence and NATO, Keir Giles, author of Who Will Defend Europe? An Awakened Russia and a Sleeping Continent. He's also Senior Consulting Fellow of the Russia and Eurasia Programme at Chatham House. Keir, really good to have you with us on the programme, and a really serious topic that we need to dig into. So are there security arrangements that we can put in place around Ukraine in some kind of peace deal that will be effective, Keir, that don't involve US boots on the ground? Because I'm trying to find an answer to that question.
Well, yes, as you heard Brendan saying just now, you've probably got European leaders this morning scrambling and saying, what are we going to do now in the face of whatever might come out next from the White House? Now, there's long been a consensus that you do need US support as the military heavyweight to make any kind of security guarantee for the eastern frontier of Europe to actually be realistic and to stand a chance of deterring Russia. Now that that has been taken off the table preemptively and a concession made to Russia even in advance of any peace negotiations for Ukraine starting, it leaves an enormous gap in any realistic deterrent. And so, of course, the conversations now are about exactly how you can make that up. And it's not looking good in terms of the capacity of European militaries to fill that gap after they have spent 30 years drawing down their forces.
It feels like we've got a duration mismatch. Europe wants to have a bigger military presence, but in order to do that, you need to have a bigger industry to support that military presence. In the meantime, we can buy from America, but then you kind of undermine the case for long-term investment in Europe. Should we buy from the US now and invest for the future? Does that work as a plan?
It might work as a plan, especially since we're now faced with an emergency situation and countries are paying the bill for having ignored this problem for so long. It is inevitably going to be vastly more costly than if defense industry and military capacity had been maintained, or even if rearmament had stepped up a decade ago when the need was already clear. But the other aspect of this, of course, is that, ironically, the actions of the US government will have made European countries slightly more wary about buying American. And that's not just the Trump administration, it's also previously under Biden. Countries that are on the front line look at the restrictions that the United States put in place for how Ukraine could use Western-supplied and American-backed weapon systems for defending itself against Russia, and the inevitable question is, would the United States do the same to us if we, as ourselves, were under attack from Russia as well? So there are all kinds of now new caveats and new hesitancies and new factors in play about deciding where and how to purchase your weapons.
Well, Keir, what does this do, just big picture here, when it comes to the attitude towards Russia? I mean, is the United States setting a tone, basically, where it had a sticking point in other countries in that relationship with Russia? I'm thinking of India, for example. Is that tone shifting? Is it getting easier for countries, not just in Europe, but around the world, to do business with Russia because the U.S.'s mood and approach has changed?
It certainly seems that way. Now, the headlines, of course, have been about throwing Ukraine under the bus and all of these preemptive concessions to Russia, essentially meeting all of Putin's demands at the same time as negotiating over the heads of the Ukrainians. But there are broader aspects to this as well that are alarming not just Europeans, but people around the world who are next door to larger aggressive neighbors. And that's the attempt at rehabilitating Russia. It's the discussions about lifting sanctions. It's the talk about the mutual visits between Trump and Putin. If the United States plays host to an internationally wanted war criminal, that's only going to encourage more bad people around the world to assume that they too can have their day.
Can I ask you about NATO? I know we've touched on this already, Keir, but a little more, because, of course, we have Article 5 and rules about NATO are written down and members are supposed to sign up to them. But you make the point in your notes ahead of this conversation that actually NATO is as fragile as the spirit of NATO. How alive is the spirit of NATO with President Trump and J.D. Vance and everything we've learned from them so far?
That's been a startling turnaround, of course. You have the United States moving suddenly from being the core and the backbone of NATO unity and the underpinning of it to being its biggest challenge, to actually mounting direct challenges to its allies in North America. Canada now and Denmark looking at a sudden security challenge from behind the lines as opposed to looking towards the front and dealing with Russia. So it's thrown a huge question mark over exactly what the commitment of the United States as that core, as that strongest member of NATO, would in fact be if it were tested. And that's when you look at the Article 5 of North Atlantic Treaty that you mentioned, the idea that an attack against one member is an attack against all, but you have to read to the end of that and understand that in order to meet its obligations under that treaty, the United States doesn't actually have to do anything at all. It can deem it not necessary.
Keir, let's talk about the nuts and bolts of how Europe rearms. Do we need an Airbus of defence? Do we need system consolidation or do we need corporate consolidation? Is MBDA the right model? And how do you solve the labour problem as well? It is hard to recruit soldiers, sailors, airmen right now into European armed forces. Just walk me through the mechanics of getting this all done.
Now, let me stress absolutely, I'm not a defense industry expert. I can see the gaps in the armed forces, filling them is not my area. But what we can see is that over the last 2 decades, we've had calls for precisely this kind of response to the gaps that are in European defense capacity. And there has been alarm across so many different countries about the way core industries like steel, like explosives, everything that you need to actually supply a military have been eroded one by one. So there is so little capacity across the continent and dependence on countries overseas, which may not necessarily be friendly disposed towards Europe in the time of a crisis. So all of that needs rebuilding on a very, very fundamental level in advance to the any grand plans for international cooperation there may be. It's got to be part of a comprehensive package of rebuilding things that have been steadily demolished over the last 3 decades.
Keir Giles, plenty of things to digest with you. We thank you so much for your time this morning. Senior Consulting Fellow of the Russia and Eurasia Program over at Chatham House. Plenty to watch ahead in terms of the trading agenda. And your day book today, you've got 10 a.m. UK time, Euro area GDP, 1:30 p.m. UK time, the focus on the States, U.S. retail sales, followed out about 45 minutes later by industrial production, and then some comments out of the Fed's Lori Logan later. But I think the highlight is that it's Valentine's Day.
Yeah. It's also retail sales.
There we
so
go.
America spending a lot on... the numbers are quite staggering. Like, I don't have them to my fingertips because I'm not paying that much attention. But I understand that there will be people out there spending money today.
You don't care that much how much Americans spend on jewellery.
I bought a card.
Well, that's
as far as we go.
That is excellent. And there's still time to buy the chocolates on the way home, I'd just say. Yes, there is. I mean, what have we got on our list then? There's plenty. Oh, there were some cultural
film festivals.
activities.
There's very little sport this weekend.
Little sport. White Lotus is out, apparently. Although Bridget Jones, that new movie, seems a little more romantic and Valentine's-y to me than White Lotus.
The Berlin International Film Festival. Come on, guys. Huge. That does it for the opening trade. The Pulse is up next. This is Bloomberg.